Welcome back to the Raw Selection Private Equity Podcast. Joining us today is Ben Claremon, partner at Devonshire Partners, a lower to middle market private equity firm in the US, investing in the micro and nano-cap space. Ben, can you share a brief insight into you, please?
Alex, thanks a lot for having me on the podcast. I've been a long-time listener, and so it's a little an honor to be on myself. I've taken a circuitous route to being in private equity. Started my career in commercial real estate in my family's business, and then started my career at a hedge fund in 2007, right before the financial crisis. So that was a fun time to start my investing career. But a lot of lessons came from that. Between that and COVID, I feel like I've learned a generation's worth of lessons. But yeah, I spent 15 years on the buy side, focused on public equities, mostly small and microcap public equities, which kind of informs part of my view as a newer private equity investor. And so I joined Devonshire Partners about a year ago, which is a lower middle market private investment firm located in Los Angeles. We focus on 2 to 10 million EBITDA businesses, founder and family led businesses that are taking their first institutional capital. We position ourselves as kind of a good third option for sellers. So someone who doesn't want to sell to a strategic and wants to keep the culture and the team together. Someone who might not want to sell to more of a buy and flip traditional private equity shop. We come with a little bit of a long-term perspective given our capital base. And so, that's not going to be the perfect option for every seller, but for people who really care about the business that for most people, it is their life's work, and how, the culture that maintains and the people that stay there. For those people, we can be a really good third option. So I guess to summarize, I'm a public equity guy who's taking that lens and, transitioning to more of the lower middle market private equity, kind of mindset. But but I also keep my toes in the public markets as I run our microcap opportunity strategy, where we are also looking to invest in public companies, either keeping them public and being a source of growth capital, or I think with the natural evolution of our strategies, a microcap take private. And I could talk to you all day about the opportunity set there, but I'll stop and let you go on.
Absolutely. What's one mistake that you see private equity firms or portfolio companies making, and what would you suggest to correct them?
Yeah, so I want to approach this question with a fair amount of humility. Right. There are people who listen to this podcast and have been on your podcast who've been doing this for 15 or 20 years. And so I want to be really careful not to tell them how to think about private equity. But I will say a couple things coming from my perspective, my unique public experience that might be helpful. The first thing is, the lower middle market, especially where we focus in private equity, has become crowded. More and more sponsors, independent sponsors, people with funds, search funds. I mean, there's just a lot of competition out there for these small deals. And the best deals out there are often quite, well attended. By these banks run really good processes, and there's a lot of, really seasoned investors and also new investors and also strategics playing. And so if you only look at the world as we invest in small private businesses that do whatever 2 to 10 million in EBITDA, I think you're missing the entire public universe that has essentially been abandoned by the institutional investment community. And I'll just go on a very brief tangent to explain what that means. Is that, if you started a microcap US public equity strategy 20, 25 years ago, there were pensions and endowments that would actually invest in that strategy. These days, that strategy is way too small for most pensions and endowments. 20, 25 years ago, there weren't $50 billion endowments like MIT's is $50 billion. Like MIT wants to write $300 and $400 million checks. That would be the entire capacity times 2 or 3 for most microcap or nanocaps public equity managers. So, if you look at the Russell Microcap Index, it is the worst performing Russell Index over every long period of time. And so it's been a space where the managers have disappeared, the capital from institutions has disappeared, and most of these companies have almost no access to capital. And so if I'm looking in a pond where there's a lot of capital entering, which is the lower middle market private businesses, and I look on the other side, which is the public businesses that are the same size, they just happen to be public, And these people have no private equity people calling them, or very few. I go to conferences and I'm the only private equity guy there. And so I just think just opening your purview a little bit and thinking about where the opportunity set is and where and how microcap US equities or Canadian equities might fit into that. I think that's an interesting kind of reframing of what lower middle market private equity is, and people in this space might, what you know open up Bloomberg or Capital IQ and see what the opportunities look like on the public side as well.
Excellent. So talk to us a little bit more about the microcap, nano-cap public company landscape, what it's looking like today from an investment perspective.
Yeah, so let's define a few things, and these are loose terms, right? Like if you just think of smaller U.S. public equities, you talk about small cap, which my former firm used to define kind of like 500 million to 3 billion in market cap, and then kind of like anything under 500 million is microcap, and then there's a subset which I would call nano cap, which is 100 million in market cap and below. Um, and so the simple answer is there used to be a lot more public equity managers that focused on this space. There was institutional capital available to them. And there was also there were certain institutional allocators who were okay with a business that can't scale. I think as scale has really become the name of the game in public equities, if you run a strategy that can't scale, because the reason it can't is because if you get too big, you can no longer invest in small illiquid securities. So the business model of being a smaller or micro cap oriented public equity investor in the US has gotten a lot more difficult, which means the talent has gone away. People have hung up their cleats to do something else, right? Like kind of like I have moved into the private world because it's just so hard to operate. And so what that means is that the traditional people who would look at funding one of these businesses either as a public, so let's just start as a public business, right? Often companies need growth capital. The sources of growth capital have dried up. Let's say there's a selling shareholder, some older gentleman or woman whose kids aren't going to be in the business and owns 30, 40, 50% of a microcap company. There's no liquidity for those people. I mean, there was always limited liquidity. Now there's no liquidity. And so the opportunity set for us, I think, is to be kind of a hybrid public-private player where we can provide growth capital to an existing public company. We can buy out a large shareholder and become a large, change capital allocation and potentially, have our own public vehicle, in by buying out a selling shareholder. Or for companies who are spending $2 to $5 million every year being public, CEOs and CFOs who spend anywhere between 33 and 75% of their time only on things having to do with being public, board meetings, SEC filings, road shows, investor conferences, conference calls. All of that takes up a huge amount of time that takes away from them spending time on their business and their people. For those people who no longer see the benefit of being public, because again, what's the benefit of being public? You have access to capital. And if you don't have access to capital, why not be private? There's a lot more capital at a much lower cost of capital in a lower middle market private equity world today than there is in the public microcap space. So, we just see a long trend of companies realizing, especially at this size, that there's no benefit to being public and looking to access capital from kind of flexible private equity players who don't necessarily have the take private hammer, right? I think one of the issues that some other private equity firms have had is they only want to do take privates. And in some situations that makes a lot of sense. And in some situations there could be a two-step take private where you buy out a founder and then later on make an offer for the rest of the shares. Or you provide growth equity to become a big player in this company, take board seats, help it grow, and then either sell to another strategic or take it private yourself. So we come from this very like, this perspective that silos, when people create artificial silos, that's where the opportunity in the alpha is. And so that's where we are trying to kind of navigate in between the public and private markets and see if we can add value to public companies, coming with this kind of private equity mindset.
Sorry to interrupt. Just a quick mention of a long-standing partnership with Grata. As you'll probably know, the private equity scene is constantly evolving, and deal flow is moving now to proprietary and data-driven processes. Grata provides you with the data and information of over 7 million private companies. So if you're looking to improve your proprietary deal flow and improve the data access, then reach out to Grata today. Now back to the podcast. So the small cap, micro cap, nano cap, seen it called lots of different things, probably not small cap because that'd be different, but micro cap, nano cap type world is, when you talk about 2 million, 10 million EBITDAs, there's obviously a lot of risk, usually sits around key man risk, and other obviously elements. What do you think, from a private equity perspective, aside from those areas, why are private equity not spending a lot of time in these kind of small public companies, obviously listed to go private?
Yeah. I think there are a lot of reasons. One is there is some of these silos that I was discussing. I talked to lower middle market private equity firms whose mandate is to invest in private businesses, and they don't even have their capital allocators who back them are not even asking them to look in this space. The second is that public deals, take privates, whatever you want to say, are perceived to be harder, and it certainly is true. You have boards with fiduciary duties. You have all kinds of case law associated with take privates and stuff like that. That there's always a risk that you get sued. Certainty of close, I think, is harder. The independent sponsor world, right? Like there are no independent sponsors operating in the public markets because it's very difficult to get to the finish line with a company if you don't have a fund, if you don't have committed capital, if you know what I'm saying? So there's a lot of reasons why people stay away. I think also there's a skill set difference, right? Like, what I've done my entire career is invest in small liquid companies and try to find ways to find shares if you want to buy them in the public market. Is to develop relationship with boards and management to try to like be invited in to try to figure out, can we be capital providers? That's a lot of work, right? And it takes time and it's a lot of relationship building. And so I think and there's no bankers involved. So there's no shot clock here. There's no bank shepherding through this process and saying, well, these are the milestones and this business is likely to transact in some capacity. With these public deals and situations, like the board could wake up one day and, on the wrong side of the bed and say, yeah, I know you've done a bunch of work, but we're not going to consider doing anything with you. So I think there's execution risk. There's broken deal cost risk. There's a bunch of silos that kind of prevent people from spending time here. And, taking a step back and saying, okay, well, why in the world would you spend time here? Is like, my personal view is that the U.S. equity markets, public and private, are the most competitive markets in the entire world, with the most well-funded, most educated, most motivated players across, any asset class in the world. And so how do you find ways to create value for investors and shareholders within that is to do hard things that other people are not willing to do, kind of navigate in between silos. And so that's really it, is to try to be really specific and targeted in our outreach to public companies, talk to them about how we can be helpful, develop long-term relationships with these people. And I tell people all the time, like, I don't know if we're going to be helpful in the next 6 months, 24 months, maybe it's 36 months from now, but I just want to be top of mind if you ever have a capital need. And so I think that that approach creates a brand that we are trying to establish, which would be a premium brand in the microcap space. And I think when people hear microcap, they start thinking about frauds and hucksters and, pump and dump and all that stuff. And totally true. I like to joke that, like, maybe there's only 10% or even 5% of the universe of companies that we can look at in the US and Canada where there's about 1,600, maybe 5 or 10% of that's actually investable. But develop relationships with those ones that are, and kind of play the long game. And so that's what we're doing. And I could just see a lot of other people thinking the opportunity cost of that time is too high, and that it's just too hard to execute when there are so many deals crossing your desk every day. Another 50 to 60-year-old baby boomer who's transitioning the business. And, I think there's 1 million private businesses in the US that do between 1 and 5 million in EBITDA. So that's a lot of deals, pretty consistent flow with a bank. It's just much easier. And I'm trying to add value by doing things in kind of like slightly harder places.
How are you mitigating the risk? What are you or well, let's ask this. What are you looking for in those businesses that means that they are investable in that 10 to 15%? What do they have to get to?
Sure. I mean, we use the same screens for public businesses that we do for private businesses. Return on capital screens, gross margin screens, customer concentration screens, the same thing. But I will tell you, and I know a lot of private equity people might scoff at this, but the same size public equity business versus the private equity version of it, or like versus the private version of it, is likely to be more sophisticated because they have to be. They have to be SOX compliant. They have to be SEC registered. They are filing every quarter, right? And so there's a process and systemization that has to be present to be a public company. That is, let's just be honest, is not always present in a $2 to $10 million family and founder led business. So, and also I typically see much less customer concentration with these public companies. Just inevitably when we see a sim for a private business that's doing 5 million in EBITDA and a niche, like, almost the base case for me is that there's a 20% plus customer. And sure, that can be a foundation for growth. And I understand that. I'm not just dismissing those businesses, but I think you can eliminate 13 or 1400 companies out of our universe with just a few simple screens, consistent profitability screens, gross margin screens. I mean, it's pretty simple because a lot of these businesses um, are microcaps for a reason. Either it's because they have a business model that hasn't been proven, they have a business model that just doesn't work anymore, it's in secular decline, it's been poorly managed. And so, yeah, I mean, these businesses are small for a reason, and you need to be looking for reasons why it's the structure that is making it small. Lack of access to capital, lack of access to um, sophisticated investors like we would do if we bought a private business, which we own two of at Devonshire. Like the same things we would do there. Like you should just go on a microcap board and tell me how sophisticated you think these board members are. Right. And so it's just, I think you're competing with investors who don't have the same mindset and same skill set that you have in the when you're competing with, excuse me, like retail investors who are investing in these companies and, small one-man microcap oriented shops. And so I think you can quickly become a partner of choice, and you can quickly become kind of like have an intellectual and maybe informational edge on these businesses. And so that's why I'm always thinking about what's our right to win. And if I go into a situation, private or public, and I can't figure out why we are a good partner, why Devonshire has a right to win there, we're going to walk away. And part of that's finding operating partners in the industry who can help two generalists become really, really knowledgeable about a specific space. And I just, coming from the public equity world, it's not like, and look, maybe this is a model that people should adopt. Why shouldn't public equity managers find an operating partner for every one of their equity positions? I mean, it's hard if you have 50 positions, but still, like conceptually, why don't people do that? It's just like this weird disconnect between the way the private world and the public markets work. Um, so the risk, getting to your question is like you, a lot of the risks are mitigated by screening out the companies, the 90 to 95% companies that just wouldn't fit your criteria, and then focusing on the 5 or 10% that can, and developing relationships with those people and figuring out where you can have a value add, just like you would in a private business.
Do you have to take quite a broad approach with regards to industries and sectors that you invest in? As you get smaller, it tends to be more broad, the lower middle market. And there's obviously examples like Vista Equity Partners, software businesses, B2B, this size, sell to this customer base, this is what we like, etc. Are you quite broad with regards to one day it's retail, the other day it's consumer, next day it's manufacturing?
Yeah, and it's funny you're anticipating. I'm just about to we're just about to release our quarterly letter, and the topic of that is the benefits, kind of the benefits and detractions of being a generalist. So let me dive in a little bit there. So I've been a generalist my whole career. I think it is a great starting point and foundation to invest in anything. When you've been doing it for as many years as I have, you have pattern recognition that helps across industries. And so, and in the public markets, it's there's certain industries you can be a specialist in, but if there's one public company in the specific industry subvertical, like being a specialist there doesn't really help you, right? So you kind of have to be a generalist. And so we've I kind of look like if the question is should you be a generalist or specialist, the answer is both to me. Is that you use the generalist frameworks and all the pattern recognition you have, and you channel that into becoming really good in specific industries. And so that's kind of where I think that our Devonshire 2.0 for us is going to be a more focused strategy. We're going to always have the opportunistic bucket open where you're right. There's going to be consumer deal tomorrow that we're going to take a look at. There's also going to be in manufacturing business. We own a healthcare business. We own a home services business. So yeah, it's pretty eclectic for sure. But I do think, and if you look at some of the, whether it's a Vista or, the Garnet Station guys who focus only on franchise businesses, like having that vertical expertise and building out multiple verticals that you have expertise in this firm, I think really it works really well with LPs. It really works well when you're sourcing operating partners, and it's probably going to lead to better returns over time. So, I mean, I think that maybe my contrarian position is that you can be both, and it's really all about circle of competence. Build, use all of your business knowledge that comes from being a generalist, and build a circle of competence that includes specific verticals where you can be super, super dangerous in. And I think, myself, I've invested in industrials and consumer businesses for, 15 years plus. And so I've got a lot of background knowledge there. And how do we channel that into sub verticals where we become specialists?
Makes a lot of sense. Not only am I the host of the Private Equity Podcast, I'm also the founder and managing partner of Raw Selection. Raw Selection's an executive search firm working exclusively within the private equity industry, supporting the portfolio companies and the private equity firms with securing exceptional talent with our motto of de-risking executive search. What have you mentioned obviously the non-atypical route into private equity. What have you taken from your world in hedge fund that you brought into private equity you thought that's been really useful?
Yeah. I think there's a lot of crossover, right? And I think the traditional private equity firm does not hire a person who looks like me because I candidly didn't have the transaction experience, right? I never wasn't an investment banker. I didn't go through that route. And so,
Mhm.
when I was thinking about making this transition, I asked people like, what's going to be the hardest thing? And people said, the analysis is very similar, right? Like you're still focused on, I've, for me, any business has three pillars. It's the business, the value, and the people, right? You're still analyzing that. The structure of the business doesn't matter. The hard part to learn is the transactional side and figuring out how to negotiate and develop relationships with lawyers and accountants. And this is an entirely different ecosystem. But, people said to me like, Ben, you can learn that stuff, right? You can learn the transactional side. And my partner has thankfully, right, just taken me along for the ride. And I've been able to learn so much about that. And so with that as the background, what am I bringing? I think one of the things that's really helpful to me is that having invested in so many public businesses over time, like I just know like when we see a business, I know who the public comps are, but I also know the businesses that are public that are also tangentially in that space that potentially invested in one of them. So, when you've been a public markets investor, you have a lot of reps, right? In terms of the analysis, in terms of companies you've owned, I was a portfolio manager. Um, and so I owned a 25 stock portfolio. So what that means is that I've just touched so many businesses and so many business models that when something comes up, inevitably, maybe outside of some biotech that we're not even going to spend time on, right? Like I've got experiences that I can draw on and companies that I've invested in and relationships that I can draw on. So I think that's been relatively seamless. And the learning stuff is more about, how do you get through a transaction? How do you negotiate a transaction? How do you structure a deal? And thankfully, I've joined a partner who's done that multiple times. He was an investment banker and a consultant, and he's done 2 deals on his own. And Devonshire's out there looking for deals every day, right? So I think the skill sets are complementary, and I look at everything as like how do you take the best of your prior experiences and layer that on, and hopefully you can come with some first principles thinking, like when you haven't been in that transactional role and you haven't been in private equity, and you just ask very simple questions like, why do we do things this way? Are there structures and research processes that from the public equity side, ways we memorialize our decisions, the way we structure our investment meetings? Are there things about that process that can be helpful? And I think my partner and I have done a good job of marrying what was, his very, kind of like banker, private equities oriented perspective and processes and philosophy with my experience on the public side, and having run really deep research processes for 15 years.
So I appreciate that you run your own podcast. Please give us a shout out about the Compounders, podcast. But what are your influences? What do you read? What do you watch? What do you listen to that you also recommend others check out?
Yeah. So thanks, Alex. So I run a podcast called Compounders. We're getting close to 100 episodes. We started off interviewing only public company CEOs. So that was great. We did almost 3 episodes with public companies, CEOs. You're the Rolodex of public company CEOs that you can just call up to be on your podcast runs out at some point. And so we moved to also interviewing private company executives and also investment managers. And so the idea is that, kind of the 2 different interviews are like when I'm talking to an executive who runs a business, I'm just talking about how they run their business. How is this, from a holistic perspective? That's strategy, philosophy, culture, people, everything from, the financials to the balance sheet, capital allocation. So we talk about everything. And then on the investment manager side, we're just talking about how do you build an investment firm that can be much larger over time. And so the whole backdrop is compounding, which is the idea of compound interest, right? Is just like it's the something that our minds just are not great at understanding. Is like, if you can compound at 15% for long enough, like it's exponential difference in size versus something that can compound at 7%. And so that's the backdrop for everything, is how are you building your business, whether that's an investment firm or a company. And so it wouldn't surprise you to hear that I'm a podcast nut. I listen to your podcast. I have my own. I would say as I was transitioning into private equity, I thought the 2 best podcasts that I listen to religiously are Capital Allocators and Invest Like the Best. Capital Allocators, because I think, you could spend all your time, looking at companies and focused on your portfolio, but hearing Ted Seides interview the people who are allocating capital, what are they looking for? What are their needs? What are their holes in their portfolio? How are they thinking about allocating capital the next 5 or 10 years? I think that's really helpful, right? To understand where, because they're going to be the suppliers of the capital for your next deal or for your next fund. So just understanding what the client, the customer really needs is helpful. And then Invest Like the Best. I think Patrick O'Shaughnessy does an amazing job of interviewing entrepreneurs, and business leaders about how they're building their business. He doesn't have, I've heard that Patrick doesn't prepare at all. He just asks off the cuff questions, which is unbelievable. As I think Alex, because you're gonna come on my podcast. Like, I do a fair amount of prep, so I'm envious of his ability just to have a wonderful conversation without a lot of prep. But yeah, I mean, it's a similar idea to what we're doing. He's like, how are you building your business? How do you think about differentiation? How do you think about competition? How do you think about growth? How do you think about people? And so, I think at the end of the day, what I'm doing every day is thinking about, like, how do you take a small business and make it much larger? And so I think those 2 podcasts, right? Like, they're so instructive as it relates to, well, how you're going to fund it if you do that, but then what are the best practices in terms of doing that and listening to people who've been really successful. I like to joke that if you're on Capital Allocators or Invest Like the Best, you've already been inducted into the Hall of Fame of investing, right? I mean, these are people who have been insanely successful, right? What we're trying to do at Compounders is find that next group of investment managers or that next group of companies that people are not as familiar with. But at what we're trying to do at Devonshire is we're trying to take a $2 to $10 million EBITDA business and make it much, much larger. So, like, just the through line through all of this is like compounding. and how do you figure out how to like be involved in a business that compounds over time.
Appreciate that. And if anybody wishes to reach out to you, Ben, post this, how best do they get in touch, please?
Yeah, Alex, thanks for asking that. I'm all over the place and everywhere. So you can follow me on Twitter at Ben Claremon. You can look and subscribe to the Compounders podcast on Spotify or Apple or wherever you find great podcasts. I have a Substack called the Compounders podcast Substack, where I write pretty frequently. I share Devonshire's quarterly letters and the writings I do on both the kind of private equity, the private market space and the public market space. You can find me on LinkedIn. I'm pretty out there. So if anybody wants to reach out to hear anything about what Devonshire is doing, my perspectives on Microcap, or just wants to hear, for people who are interested in getting into private equity and have come from the public equity background, I'm happy to talk about my journey and the trials and tribulations and the bumps in the road that have happened over that period of time.
Well, thank you very much for joining us on the Private Equity Podcast, Ben. Lots of value, lots of insights, and a different perspective. I don't think we've ever had anybody with a hedge fund background on the podcast as well yet. So thank you very much for sharing everything you have.
Thanks, Alex. Appreciate being on the show.
And as always, to everybody tuning in yet again to the Private Equity Podcast, thank you very much. Till the next time, keep smashing it, and thank you very much for listening.